Hello, everyone. I'm Miles. Today, we're going to talk about a concept in accounting and finance that's often misunderstood but extremely important: goodwill. A lot of people think goodwill just means overpaying, but that's not accurate. This misconception can make you lose clarity in valuation and undermine your professional credibility in real M&A discussions. Goodwill is not the present value of future synergies. It is the portion of the purchase price that cannot be separately identified or reliably measured on the acquisition date, but reflects the expected future economic benefits. Because of this, goodwill cannot be amortized. It can only be monitored through impairment testing. Goodwill is a way of thinking, so today we'll truly understand it by working through some problems. Suppose Company A acquires 100% of Company T shares for $1,520 million in cash. The book value of T's net assets on its balance sheet is $1,050 million. But mergers and acquisitions are never just about book value. The book value reflects the past, while M&A focuses on economic reality. On the acquisition date, we have the following fair value information. PPE, property, plant, and equipment, is undervalued by 180, which is tax deductible. The fair value of internally developed brands is 260, which is not tax deductible. The fair value of customer relationships is 120, which is not tax deductible. And long-term liabilities are undervalued by 70. The income tax rate is 20%. We have only one goal: to calculate the fair value of the identifiable net assets, as well as the final recognized goodwill. Step 1. The pitfalls of fair value and taxation. Fair value brings invisible assets onto the balance sheet, but always remember this: accounting recognition does not equal tax recognition. For each adjustment, ask one question: will it affect future taxable income? The 180 is tax deductible, so it does not generate a deferred tax liability. The brand and customer relationships total 260 plus 120, which is 380, and are not tax deductible, so they generate a new deferred tax liability, DTL. The deferred tax liability is 380 times 20%, which equals 76. Step 2. The fair value of identifiable net assets. Start with the book value of net assets, 1,050. Adjust to fair value. Add 180 for fixed assets, add 260 for brand, add 120 for customer relationships, subtract 70 for liability revaluation because the debt was understated, and subtract 76 for deferred tax liability because the new brand and customer relationships generate new deferred tax liabilities. The fair value of identifiable net assets, net identifiable assets, is 1,464. Step 3. Goodwill is what's left over, not a mistake. Goodwill equals the purchase price of 1,520 minus the fair value of identifiable net assets, 1,464, which equals 56. Goodwill is not a number that's just stuffed in, nor is it a calculation error. It's the portion that's left after all fair value liabilities and tax effects have been fully and accurately reflected. Goodwill represents potential synergies, organizational capabilities, strategic positioning, and future growth. To sum up, deferred tax liabilities, DTL, arise from intangible assets that are recognized in accounting but not deductible for tax purposes. DTL reduces the net identifiable assets, which in turn increases goodwill. Goodwill doesn't mean you overpaid. It's a reflection of future economic benefits. If you can explain goodwill this way, you also understand M&A pricing, the purchase method, accounting valuation logic, and tax implications. This isn't just about accounting. It's a clear way of thinking in the capital markets. After all, in the world of finance, clarity itself is an asset.